Hello, I'm Nick Axford, Head of Research for Asia Pacific for CBRE, and joining me today to look at the real estate market in India is Abhinav Joshi, our Head of Research in India. Abhinav, thanks very much indeed for joining us. Let's have a look at some of the key issues that we see in the market at the moment, perhaps, however, kicking off with a look at what's happening in the economy.
Well, thanks a lot, Nick. The economy growth has stagnated over the last 2 years. GDP has declined to as low as 5.3% in the quarter ending September 2012. And for overall 2012-13, we expect the growth rate to be between 5 to 5.5%, which is substantially low compared to the highs of 8 to 9% that India achieved a couple of years back. I think this is a broad-based slowdown which is being felt across sectors, particularly manufacturing, capital goods, consumer goods. During the review period, we've seen that there's been persistently high inflation. There's been high borrowing costs amidst this overall economic slowdown. And as a result of which, the base rates have been kept stable by the central bank, which didn't really support the structural reforms that the government was trying to introduce in the economy till the end of last year. However, what we've seen in January 2012 is that there was a marginal cut of 25 basis points introduced in the base rates. So that's sort of helped towards dispelling the general feeling of gloom and supported the government, motion towards maintaining structural reforms in the economy. Along with, relaxation in the interest rates and contained inflation, this is going to support the various institutions to offer better rate of interest on loans and may also increase employment in infrastructure and development projects. As far as investments are concerned, they've been down from 2011 by almost 30 to 40%. We were up at $47 billion in terms of the total FDI inflows in 2011. That was supported by some really big deals. This year, it is expected to be in a range of $20 to $22 billion. However, we feel that inflows are going to appreciate over the coming months as the government continues to implement more meaningful and more inclusive reforms which are more effectively implemented. I think that's going to send really positive signals to worldwide investor community, particularly the fact that we have the central budget lined up next week. And there are a lot of expectations as far as the industry and specifically the real estate sector is concerned from the government to continue to liberalize foreign investment guidelines, promote large-scale infrastructure projects, enhance private sector participation, and create a positive investment climate.
Okay, and so how do we see all of this translating into activity in the office sector from a property market point of view, and what do we think about the outlook for that sector?
I think the overall sentiment of economic gloom has, moved into the office market as well. As we can clearly see, office transaction activity dipped by almost 26% in 2012. And that was felt across sectors, whether it is IT, whether it is BFSI, consulting, manufacturing, telecommunications. We saw that overall occupiers were very cautious. Cost controls were an overriding concern. Consolidation and relocation were happening simultaneously. So the focus was more on more efficient use of their existing portfolio rather than implementing any further expansion plans. And as a result of these cost controls, because of the overall economic situation, we saw that the average space leased every quarter, average quarterly absorption dipped from about 8.3 million square feet in 2011 down to just about 6.4 million square feet in 2012. Now that's almost leasing 2 million square feet less every quarter. As far as the major hubs are concerned, again, Bangalore, Mumbai, NCR, they are the tier 1 cities, and bulk of the transaction activity, almost 70% of it in 2012 and in the fourth quarter, continued to remain in these three cities, wherein IT and support services were the largest occupiers. As far as the rents are concerned, I think the entire, focus on cost and, consolidation and limiting expansion plans has had an impact on rents as well. Rents were very stable in Q4 with downward pressures across most micro markets. what we clearly see is that rents have almost touched their peak in some of the suburban markets such as Gurgaon, Noida, Whitefield, and Outer Ring Road, while they're still way below their peaks in most of the CBDs, which is clearly indicative of the fact that activity has clearly shifted from the city centers to more decentralized markets. Rents were very stable across most markets. Occupier expansion faced cost pressures, and consolidation continued to be a key theme. And it is anticipated that downward pressures will continue to persist on most markets in the country, at least in a short to medium term.
Okay, and turning to the investment market, I mean, we see a lot of potential interest in investment into India from outside the country, but from a property point of view, that's quite heavily regulated and not the easiest. But I mean, in general, the activity in the investment market seems to have picked up recently.
Yes, it has definitely picked up in 2012. In fact, the overall transaction volumes for 2012 were in a range of $4 to $5 billion or in excess of that. And that was almost twice or thrice of what was witnessed last year or in 2010. That's largely because, recent months have seen several groups sort of offloading their land parcels or their stakes in projects or in non-core assets in order to raise cash. Now, that's part of their strategies to disinvest in their core as well as non-core assets. So what we've seen is that as valuations peaked in 2012, a lot of private equity players have sold stake in projects, exiting their investments that were made during 2005 to 2007 period. The buyers, on the other hand, feel that there is still some substantial upside available in the market, hence they are willing to put in their money in good properties with good location. So that's, I think, one of the major reasons why we see such a huge spike in transaction activity. Again, it's largely led by Mumbai, Bangalore, and Delhi. Mumbai particularly, we have seen a lot of transaction, which are either buyback or which includes key players exiting their present investments or developers trying to sell off their, core or non-core assets, the likes of DLF, etc., in order to raise cash. So I think that's what has resulted into this spike of investments in 2000.
Okay, good. And one of the other major stories of 2012 is the ongoing saga of reform in India, particularly around the retail sector. And after a couple of false starts, it does look as though we're seeing the start of a genuine opening up of the retail sector. Can you talk us through a bit about what's happening and what you think the impact might be?
I think a very key story for the fourth quarter and particularly for the month of December was the fact that the Indian Parliament unanimously approved foreign investment in multi-brand retail, thereby just opening the totally untapped and unorganized retail sector of India to foreign supermarket chains. That's been a very positive signal to worldwide investors, and we've seen a lot of players, the likes of IKEA, Pramod, Favors England, Damiani, Brooks Brothers, who've not only planned out their India plans, but they've been given approvals from the government, from the cabinet. And there are chances that we are looking at a total investment of about close to $2 to $3 billion in this sector, at least in the next 5 to 7 years, and perhaps even more than that. So I think, the move is very positive, and it's definitely going to be implemented. It's being left to the states, individual state governments, but a lot of states in India are looking very positive towards enhancing the scale of organized retail in their respective regions. A very important concern for foreign retailers was the clause of sourcing 30% of their raw materials from micro, small, and medium enterprises in India. Even this clause has been sort of diluted by the government to support investors, and this mandatory clause has been made preferably from micro, small, and medium enterprises, so they can source from large-scale industries as well. The government has also done away with the rule stating that brand owner and the applicant company need not be the same entity. So I think overall, what we do see is that there is a lot of movement happening as far as the government is concerned, and as far as the retailers are concerned. They're trying to come on the same platform as far as these legislation and the conditions are concerned, and we see a lot of movement and a lot of investment, particularly from single brand retailers in the next 6 months.
Okay, great. Well, that's all we have time for now. Thanks very much indeed, AJ, for taking us through that. Of course, there is a lot more to talk about many different aspects of the Indian market. So please do feel free to download any of our reports and publications from our website, or indeed to contact AJ and the team in India if you'd like more information. And of course, we do have a wide range of other reports, podcasts, video broadcasts, and other presentations available on cbre.com or available through other media channels. Thanks very much indeed for joining us, and we'll hope you'll be back with us again soon. Thank you.